All right, today we are diving deep into a really powerful strategy for anyone in the tax world: how to fix past depreciation errors. And look, this goes way beyond just filing an amended return. We're going to get into the technical weeds of using Form 3115 and something called a Section 481A adjustment. The goal here isn't just to recover what can be a ton of capital for your clients, but also to make their fixed asset records totally bulletproof. So let's get right into it.
So here's our roadmap. First, we'll lay out the problem. I call it the depreciation trap. Then, we'll see how a simple mistake actually locks you into an official accounting method. After that, we'll get to the good stuff, the solution, the Section 481A adjustment. And we'll even explore how to supercharge it with cost segregation. We'll wrap up with some critical procedural details, and then pull it all together to show you why this is way more than just a compliance headache. It's a huge strategic play.
And make no mistake, the reason this whole process is so critical is because the default rule from the IRS is, well, draconian. That's really the perfect word for it. It's basically a penalty that punishes taxpayers for deductions they never even took. Let's unpack exactly what that means.
Okay, let's kick things off with Section 1, the Depreciation Trap. This whole thing starts with a core principle in the tax code, a little something called the allowed or allowable doctrine.
So here's how the trap gets sprung. Under Internal Revenue Code Section 10116A2, the law says you have to reduce your property's basis by the depreciation you were allowed to take. It doesn't matter if you actually took it or not. Basically, the IRS's position is, hey, you were entitled to that deduction, so we're docking your basis whether you claimed it or not.
And this is where it really hurts. Let's say you forget to take depreciation on a building for 5 years. No big deal, right? Wrong. When you go to sell that building, the IRS calculates your taxable gain as if you had taken all those deductions. This creates what we call a phantom gain. You literally end up paying real tax on savings you never actually got. It's an incredibly costly error.
Now here's the part that trips almost everyone up. You might think, okay, fine, I'll just go back and amend my last 3 tax returns. But you can't. The moment that mistake becomes what the IRS calls an established accounting method, the rules of the game change. Amending is off the table. You're now required to file for a formal change of accounting method.
So that leads us to the next big question. How in the world does a simple mistake become official? Let's dig into this concept of an established method. Well, you can thank Treasury Regulation 1.446-1E for this one. It's crystal clear. If you use an incorrect method, and get this, taking 0 depreciation when you were supposed to take some is considered an incorrect method for just 2 years in a row. That's it. You've done it. You have formally adopted an impermissible accounting method, and now you're stuck with it until you formally change it.
And the regulation is incredibly specific about this. It's not just about that total failure to claim depreciation. Changing from straight line to MACRs, correcting a recovery period from 39 years to 5 years, even fixing a convention error. All of these common adjustments are officially considered changes in accounting method. So a whole bunch of different errors fall under this umbrella. Okay, so we've set the stage, we understand the trap. Now for the good part. Let's talk about the elegant and, frankly, powerful solution, the Section 481A adjustment, which you make using Form 3115. So, the one and only way to fix this is to file Form 3115, the application for change in accounting method. This is the specific form, the exact vehicle the IRS requires you to use to formally switch from your old, wrong method to the right one. It's how you get to go back and fix those depreciation schedules retroactively.
So how does this actually work? Well, the calculation, which is called the Section 481A adjustment, is basically a big reconciliation. It's pretty logical. Step 1, you figure out all the depreciation you should have taken since day 1. Step 2, you subtract all the depreciation you actually took. The difference between those two numbers is your 481A adjustment. It's designed perfectly to make sure no deduction gets missed or double counted.
And this right here shows you just how powerful this fix is. That total cumulative amount, which can easily be hundreds of thousands of dollars, becomes a massive catch-up deduction. Because you underdepreciated, it's a negative adjustment. And here's the best part. You get to deduct that entire amount in the single year you file the Form 3115. Talk about a significant and immediate tax benefit.
Now, as powerful as that is, we can actually take it a step further. This whole strategy gets turbocharged when you combine it with something called a cost segregation study.
So what is a cost segregation study? Simply put, it's an engineering-based analysis that carves up a building into all its little pieces. So instead of just lumping the whole thing together as 39-year property, it identifies things like carpeting, wiring, or landscaping that legally qualify for much faster write-offs. We're talking 5, 7, or 15-year property.
Okay, so here's the crucial link. Let's say you've owned a building for 10 years, and then you do a cost seg study. Well, your original treatment of the carpet as 39-year property is now considered an established but impermissible accounting method. So to change it to the correct 5-year life, guess what you have to do? You got it. You have to file a Form 3115 using a specific code designated change number 7. And this is where the strategy becomes just incredible. You see, standard 39-year building property isn't eligible for bonus depreciation. But the 5, 7, and 15-year assets that you identify in a cost seg study are eligible. This means your 481A adjustment isn't just catching up on old, slow depreciation. It's a tool to go back and retroactively claim a massive amount of bonus depreciation on those assets, often at the 100% rate from prior years. It's a huge windfall.
But you really have to be aware of the clock ticking here. Under the current law, the power of bonus depreciation is stepping down every single year. Acting sooner rather than later allows you to capture a much larger percentage of that accelerated deduction. So the timing on these studies is absolutely critical from a strategic standpoint. Okay, now for some of the procedural details that are absolutely key to making sure this works. We need to talk about those designated change numbers, or DCNs, and the incredibly valuable audit protection you get by filing this form.
This table breaks down the DCNs you'll see most often. DCN 7 is your workhorse. That's for correcting an error on an asset you still own, and it's the one that generates that big catch-up deduction. Now, DCN 107 is fascinating. You use that to fix the phantom gain on an asset you've already sold. And DCN 8 is for when you're changing from one correct method to another, which doesn't create a catch-up but just changes things going forward.
Now, this might be one of the biggest benefits of all, and it's laid out in Revenue Procedure 2015-13. It's called Audit Protection. When you file a Form 3115, the IRS is generally blocked from going back into prior years and making an adjustment on that same item. What's even better, this protection can sometimes apply even if you're already under audit, as long as the change is favorable to you. It effectively puts a shield around your past fixed asset records. Okay, so let's pull all these threads together now and really look at the big picture here. Here's the bottom line. Form 3115 is not just a form for fixing mistakes. That's thinking too small. When you really master its mechanics, you realize it's a profound strategic tool. It lets you optimize how you recover capital, generate massive, immediate cash flow, and permanently audit-proof your historical fixed asset ledger. And that really leaves us with one final thought, a question for you to consider. Take a look at your fixed asset schedule, or your clients'. Do you see it as just a boring, static record of the past? Or, knowing what you know now, can you see it for what it really is, a dynamic tool, a treasure map to strategically recover and unlock cash flow for the future?